here is the important thing to understand, this concept of a wash sale. So folks are on Robinhood or all kinds of different trading platforms, buying and selling stocks in rapid fashion, holding for short amounts of time, turning them over, and then coming back to them sometimes. And so the IRS in particular has known that this is an issue for a really long time. And they just say, well, hey, if you're buying this security and selling it right now, if you bought or sold it 30 days earlier or later, then we're just going to kind of all count it as one. It flows one into the other. You can't, it washes together. That's why it's called a wash sale.
Meaning, and said differently, what people will do is they'll sell a stock that say lost $1,000. And the idea is I could book that as a loss against other gains. But to Corey's point, if you do that in less than 30 days, they cancel out your ability to produce that write-off against the gains you would have had.
So the example in the article is you buy 100 shares at $10 a share, you sell them at $7 a share, which means you have a loss of $3 per share, $300. But then the very next week, you purchase them again at $6. Well, that wipes out your loss. You don't get to keep that loss just because you had sold it before, because you didn't wait long enough. So that means that you actually have a bigger gain to pay taxes on, but you don't always have the money. And that's what happened to this person. Now, it could be a 21-year-old that's an unidentified retail trader. So they could be a 21-year-old buying their first stocks. They did put 30 grand into the account. So that's either like a lot of bar mitzvah money, or they're maybe a little bit older and put some money together over time. But here's the other trick. Robinhood gave them 90,000 on margin, meaning he only put 30 in, but he was able to trade with 90 because Robinhood will lend you a little bit of their money to go do some trading. Now, again, if you didn't listen to our show last week, go back and listen to how Robinhood makes money, which is not on us making money, but on us trying to make money, which is a very different thing. And that's why they're very eager to give us more room to move, because the more we trade, the more that they make.
Well, and that's, speaking of the amount of trading, I'm just highlighting this for our audience, is that he traded so much. It was $45 million of total volume of trades.
So think about that. 40. What is that? 45 million divided by 90,000. That's turning over his portfolio 500 times in the course of that year.
Which is like, if they're doing 10 to 50 trades a day, that might just be 100 days. But 100 days of trading that much is, I would think, dang near a full-time job, or should be if you're researching all those trades properly.
Mm-hmm. So his total profit was $45,000 at the end of the day. That's like actual more cash that he had in his account than when he started. But because of this rapid trading and the wash sale rule, he had actually generated $1.4 million in capital gains tax. Now, if you're holding a stock for less than a year, that's all taxed as ordinary income. So whatever other money he made, that $1.4 million went right on top, ratcheting him up the tax brackets, and that's why his potential tax bill was around $800,000, because he got himself into the top marginal income tax bracket with phantom money.
Well, and if we think about it, Corey, just kind of coming away from our screen share for a moment, this might be a super successful trader, meaning like they really had somewhere in their trades 1.4 million of profits, but when it comes time to close out the year and actually have to pay the taxes, if they recognize those gains, then reinvested having to take the gains that they already sold, but now the value of those stocks is down when it comes time to pay the IRS, you literally can have a tax bill and not have the asset to pay the tax bill.
It's wild.
And it is what it comes down to that we talk with our clients a lot about, and we talk on the show a lot about, is that it's important that you increase your human capital in any endeavor you're trying to produce an outsized return. And in this case, this person spent all their time just focusing on which stock they thought was going to move a certain direction, and not enough time in understanding the basic tax consequences of those decisions. So as always, when you're going into a new space and you think you're going to produce high returns, whether that's real estate, stock trading, crypto, you want to make sure that you can identify where your human capital is actually producing some value in the marketplace that would have you rewarded the way you're being rewarded. Because without that, you can end up in a situation like this, where there's an unknown circumstance you didn't know how to plan for. And not that the information wasn't available, but you hadn't synthesized it in your life in a way that actually helped you benefit from those higher returns. Mm-hmm. So
one other really quick thing on this article, if you notice towards the end, they reference this financial advisor, Brian Ruck, and then per Forbes. So there's this really hard to see link. Mm-hmm. When you click it, it takes you to the Forbes article that was the source for this article on the hustle. And so think about this. If someone else had referenced this article as a quote to talk about it, you'd have 3 different sources, but that's really one source. Now it's Forbes, and I looked through it, and it says all the same things, and we know that the wash sale is real. We can verify that. But if this was some other topic, you could really easily get into a situation where one bad source created 3 different references, and you thought it was real, but it really had no grounding in reality. So that's always something to watch out for with these linking articles and articles referencing each other.
Yes, great point. I think in journalism, they call it geocitis, where one person writes an article, then it gets referenced, maybe even on Wikipedia. And yet it was all based on an initial set of data that didn't even back up the original headline of the first story.
Right.
And so, so to your point, it's like when we're reading these things, you don't want to read financial articles as an uncritical reader. You want to read them. You want to say, where does it apply to me? But then be critical enough to know, where does the data come from?